16th, is it right?
Yeah.
Today is 16th. Okay. What is the maximum? But this is why this chapter is important. Is this we are using in every case. Okay, wherever it's possible, we are using that. Fine. In most of the calculations we use. You know this. I don't want to make that much. Why? What is meant by recognition? Recognition in financial statements. What is the criteria? Okay, recognition criteria. Little bit, this is important. We have know what are the assets, what are the liabilities. Again, we are going to cover this in chapter 9, financial instruments. Okay, financial instruments will cover. Income, expenses also. What is the income, what are the expenses? We have done extensively. Is it right? We have done extensively. Historical cost, current cost, value in use we have done. Where we have done value in use?
Chapter 2, Doctor.
Impairment.
Impairment, yeah.
Is it right? Impairment. I think chapter 4. Okay? Chapter 4. Is that impairment, value in use? The same concept will not say carrying amount, value in use, is that replacement cost, all the things. We have current cost, historical cost, and we have done fair value also. Okay? Fair. Discuss the advantages, and this is the basics. Okay? This is the basics. Because why we are doing this? The entire financial accounting is that the one of the drawbacks, limitations of financial costing, financial accounting is it is one of the limitations. Is it right? One of the limitations of financial costing is historical cost. We have current value. Okay, we have this. Now I will tell you very clear. We are covering only at this place. Subsequently, I don't think so. We will cover more anywhere the current value concept. Okay. Now, what is the historical cost? The actual cost what you are paying. Is that the actual cost for the actual amount of cash paid or consideration given to the item? Everything, whatever, see what happened, yesterday you are paid 10 reals, okay, yesterday you are paid 10 reals, fine, that's okay. The same product you are paying, either you will pay 9 reals today or you are paying 11 reals today. Is that? This is the history. Once it happens, it is a history. It happens on 1st, it happens on 15th of April, fine, it is done. It is happening on 16th of April, fine. That is history. You cannot change. We cannot change the invoice value. You have the current cost. Okay, the cash that would be, what is the current cost? Paid to replace the asset at current values. Okay, you are going to replace the asset at the current values. Is that? Next, fair, what is the fair value? In an arm's length disposal. This is financial accounting word. Is that? Fair value means, see, you extend your hand. Okay, you extend your hand that much. Is it right? When you are saying it's arm's length, it should not be overpriced or it should not be underpriced. Is it right? Fair value. And you should have, what are the conditions of the fair value? We have done in cash generated units. CGU. Any idea? What are the conditions of CGU, cash generating units? Your assets should be sold for the next within 12 months. Is it that they should be they have decided to sell it at? Is that you have to identify the buyer? Okay, you have to identify the buyer. The intention has to be very clear that you are going to sell it, and you have to say the value should be reasonable. Is that there should be a value which is going to be reasonable? Is that where people are going? Arm's length disposal, arm's length transaction. Keep it in mind. Remember this. Okay, it's very easy. It's like it is your arm. Is that this is your arm. Is that this is your hand? If you extend it, you can extend till here only. You cannot go beyond this. Is that you cannot catch anything beyond this? Now you will take less than this. Is that maximum that much amount, that much value you are going to say? Value in use. Here value in use is the discounted value of future cash flows. The discounted value of future cash flows. So what will be the future value? What will the future? The same thing we have done. We have discounted with the discount rate and we have calculated what will be the future. That's very important, is it? What will be because what happens? Time value of money. Is it right? Time value of money. This you are going to cover in financial management. The value of money will decrease. The value of money will never increase. Okay, the value of money will always decrease. The value of money will never increase. That is the reason we are talking in terms of fair value of time value of my future cash flows. We have done, maybe you have done in your bachelor's. Okay, most items held at historical cost. Fine, that much is enough for us. Okay, now they are talking about they are giving some reasons. Is it right? Traditionally, accounts have been presented. Traditionally, you have to use we are using historical cost also. We are using historical cost in financial position. What we are doing, how you are going to show assets. Assets are stated in the financial statement at cost less depreciation. Is that this is what we are doing, the normal procedure. Fine, just read this. Okay, nothing is there. They are giving you some basic explanation about historical cost. Accounting transactions are recorded at their original historical. Monetary means value. Okay, monetary means it is a value. Is that items are events for which there is no value, we will ignore altogether. Is that if there is value, we will add. If there is no value, we will not add it as such. Income from each period is normally taken only when it is realized in the form of cash or in the form of which it had converted. Means see the thing. Here what is there? We have the accrual concept. Is it right? We have accrual concept and we have realization concept. Is it? Realization concept. What they say, it will be taken into account when it is realized. You have given money. Take a man. A bank is given loan. Okay, a bank is given loan. When you have given the loan, bank is given the loan, unless it is repaid, is it right? You will not show it as a cash. Okay, you will not show it as. Otherwise, what you will show? You always show it as a outstanding. That what is the message from here we are getting? If anything, unless it is not, you have not received it, don't treat as a cash. You may receive future, fine. You may receive tomorrow, that's okay. But you are not receiving now. You have not received now. So then you should not treat it as a cash. Is it? Profit is the period, is profit for the period is for what we are doing. We are talking about matching concept. Is it right? We are talking in terms of what? We are talking in terms of matching the revenue with the expenses. Is it? Matching the revenue with the expenses. A simple concepts are there. What is this is the very basics. Okay, this is easy to understand. What is the advantages? Nobody will ask. I'm telling you on record, nobody will ask this. Okay, this straight to produce. Historical cost are objective. It is free from bias. Is that historical cost? Financial statement do not record gains until they have realized. Is that these are the few examples, few advantages or disadvantages of historical cost accounting. You have the disadvantages also. Okay, carrying amount of non-current assets is usually, is it carrying amount of carrying amount of non is often substantially below the current value. What is the formula for carrying amount? How we have calculated carrying amount?
Cost minus depreciation.
Cost minus
Depreciation.
depreciation. Is it right? Cost minus depreciation. One minute. Okay, cost by one second. Cost minus depreciation. See, inventory in the statement of financial reflect the prices at the date of purchase. This is all the means. What happens? We have yesterday we have purchased for 10 reals. Is it right? Now you are purchasing. You will purchase by 11 reals, or you will purchase by 9 real 500. But whatever the invoice price is there, is it right? Whatever the invoice price is there, that is the price we will take it. Is it right? Statement of profit and loss account do not reflect the current values. Definitely, historically we will not use current values. Profit is distributed in if profit is distributed in full, operations means you cannot. If you see what will happen, you will have profit after taxes. Is it right? Minus you will pay dividends. Is it? Minus what will happen? You will have some retained earnings. Is it? You should have, will have some retained earnings. If you pay all the profits to the shareholders, will not have any amount for any reinvestment. Is that any amount for no account is taken of no account is taken of the effect of increasing process on monetary items. Monetary items are nothing but the items which are related to cash. Most of the time monetary items are current assets, excluding inventory. Okay, excluding inventory. The overstatement of profits or understatement of assets prevent meaningful calculation of ROCE. Have you covered return on capital employed previously in your ratio analysis? Have you done? Yes or no?
No, that's all.
Is it? Keep it in a very important formula. Okay, profit before interest and taxes divided by capital employed. Okay, this is the formula for return on capital employed. Okay, we will do this. What they are saying that if we cannot overestimate or we cannot overstatement of profits or understatement of assets will definitely prevent us to have a meaningful calculation. We should not overestimate, we should not underestimate. Fine, this is with respect to the historical, because they made very simple. Keep it in mind. I will make you understand this. Company A acquires machine 2004. The machine is how much? The machine is 50,000. Estimated life is how much? 10 years. Is it? Company B have identical 1-year-old machine. The company acquired an identical 1-year-old machine 2005. Cost is how much? 48,000. Estimated life is how much? 9 years. See the thing. One machine you have acquired for 50,000. Depreciation is how much? 5,000. One machine you have applied, irrespective of whenever you have applied. We have paid amount. That amount is final for us. We cannot change that amount. Okay, we cannot change that amount. While calculating depreciation, we have to calculate depreciation for two different machines. One machine at the rate of 50,000, another machine at the rate of 48,000. The depreciation amount will change. Okay, so whatever given in the question, we have to follow that. As simple as that. We should not do anything from our side. Okay, company, what will happen? Company A at the end of the year, at the end of 2005, company A is how much? This is 2 years old. The asset value is how much? 40,000. This is only 1 year old. Okay, the asset value is how much? 42,667. Is it right? Means now I am telling you this very specifically. Whatever the amounts is given, we have to take the amounts. Sometimes we'll get negative values, sometimes we'll get positive values. We should not concern about that. We have to follow the rules. Based on the rules, we have to work it out. What is the replacement cost? Is the replacing the asset. Simply the name itself say. Is it right? I will give an example. You will have the computers. Is it right? Computers. Now you want to replace the computers with laptops. Is it? Replace the computers with laptop. Definitely, when you are replacing it, you will have some additional cost. Is it right? However, is a non-current asset situation, you need to determine net replacement cost. Okay, this is what important. What is the net replacement cost? Is the replacement cost of an asset less appropriate amount of depreciation. Always keep it in mind. Non-current assets is the replacement cost is the replacement cost of the asset minus any depreciation is there. We have to reduce the depreciation. What they are saying I will put it in statement form. You have a historical cost of how much? 500,000. Life is going to be how much? 5 years. Is it? What is the carrying amount at the end of year 2? Carrying amount at the end of year 2 is 300,000. Is it right? Now, how much is the depreciation at the end of year 2? 2 years depreciation. Is it right? Automatically, depreciation for one year will be how much? Every year the depreciation is, this is per year. Is it? This is per year depreciation. 100,000. Fine. Now, if the current price of an equivalent new asset is how much? 600,000. Is that we want to replace it? Is it? We want to replace it. How much is the cost of the current asset? 600. Is it right? Then what will happen? Then the value using replacement cost will be how much? 360. Is it? 600,000 less 2 years depreciation. Is it right? 600,000. Here also what you have to make it equivalent. Okay. I will put like this. This is asset 1. This is replacement asset. Is it? This is the replacement asset. What we have done? We have taken the asset 1 of 500,000 into 2 years depreciation. 2 by 5. Is it right? 500 minus 2 years depreciation. It comes to how much? It comes to 300,000. Any doubt anywhere? Just you ask me. I'm here to help it out. Okay? I'm here. Salaam alaikum Hussein. Fine. Next. Whereas replacement cost is how much? 600,000. Okay? Replacement. Now here also what you are doing? You have to calculate 2 years depreciation. Is it? You have to calculate 2 years depreciation. 5 years. 2 years depreciation will be how much? 120. Okay? 6, how much it will come? Yeah, 600,000 divided by 5. 120 per year. Each year. Is it right? 120 each year. How much you will get? 240. Is it 240? What is the carrying amount of this after 2 years? 360,000. Here the amount is how much? Here the amount is 300,000. Means we have to make it equal. Is it? That we have to make it equal. Then only we can say that replacement cost. This concept, just hold it, okay? Understand it. I am 3 things I will tell you very clearly. Always keep it in mind. First is I want to make sure that you memorize it. Second one I say you understand it. The third one you say remember it. Is it? Remember, fine. Understand means you should understand the concept. Okay? You should understand the concept. Means you should, whenever you are comparing, whenever you are comparing, you have to compare equally. Okay? You should not compare one with a higher value, one with a lower value. Replacement cost talks about this. Understand this. Okay? Net realizable value. We have done. What is the formula for net realizable value? Fair value less cost to sell. Is that now almost every lecture we will cover new things as well as we will revise what we have done also. Understand what we have revised? I will make very clearly. Yes, we have covered this in the previous cases. Okay, economic value in use. You are not selling the asset. Okay, you are not selling you are using the asset. Even that case, in that case, what you will do? You will calculate the present value of future cash flows. Is that you will calculate the present value of future. We have done what? Net realizable value, value in use, and replacement cost. They have given a small example. Okay, a company they are asking us what? They are asking us all four. Is that they are asking us all four? Read the question fast, everyone. A company owns a machine which is purchased 4 years ago. How much? See the thing. Cost is how much? Cost is 100,000. Life is how much? Life is 4 years. See, this will be there in 20 marks question for 2 marks. Understand? But a small adjustment will be there. A small adjustment will be there in the big question. Okay? That accumulated depreciation is how much? The accumulated depreciation is 40,000. Is that the machine could be sold to another manufacturer? Is that if you are going to sell? Is it right? Sell. If you are going to sell, it will be 50,000. They have said cost to sell is how much? Cost to sell is 5,000. To replace with the new version, is it right? If you are talking about the replacement, is it right? If you are talking about the replacement, how much it will cost? It will cost 110. The cash flows from the estimated value in use. Okay, the cash flows from the existing machine are estimated how much? Cash flows is how much? Cash flows is 25,000 for 2 years. Is it right? For 2 years. And for the next 2 years, is it? And 20,000 for the remaining 4 years. Is that for the remaining? They are talking about what? They are talking about the discount rate. Where we are using? We are using this in the value in use. Whenever they give discount rate in this situation is used to calculate present value. Okay, to calculate present value. We use in where? We are using this in value in use. Okay, value in use. They are asking us calculate the following values for the machine. Okay, now it's very simple. Historical cost minus depreciation. Is that cost minus depreciation? What is there? This is the carrying amount. Is that this is the carrying amount? Next, net realizable value, selling price minus cost to sell. We have done this. Nothing we are doing new. Is that selling price minus cost to sell? This is going to be called as a net realizable value. Okay, you will write like this, NRV. Is it net realizable? The replacement cost. See the thing. What we have done, replacement cost of the new asset. Same rule we have applied there. Replacement cost is 110,000. We have calculated depreciation. Is that we have calculated depreciation. We have calculated depreciation for how many years when they have purchased it. That replace a cost with to replace the machine with a new version with cost 110. The cash flow from existing is 12,000. When they have replaced it, to replace the machine with a new version would cost. The accumulated issue to date is 40,000. It purchased 4 years ago. What is the life of the machine? The machine owns purchased 4 years ago. For the accumulated depreciation is the machine has been sold to another for 50,000. What they have mentioned? They have mentioned for 1 by 10. 4 into 1 by 10. 4 years. How much you will get? Just calculate it fast. 110 divided by 10 into 4. Yeah, 4 years they have taken. Okay, they have taken it for 4 years. 110 times 4 years, and total is 10 years. It comes to 44. They have made this line. That is the reason there is a confusion. Okay. In the beginning also we have taken 4 years depreciation. In the replacement cost also we have to reduce 4 years. How much is the replacement cost? Replacement cost is 66,000. Understand this how we are doing. Economic value. Economic value is nothing but value in use.
Victor, the 10 years from where?
Here it has been given us here. Yes, 10 years from where. Now what they have said that the machine owns a machine which has purchased 4 years ago. 4 years ago, how much they have purchased? They have purchased it for 100,000. Is it right? The accumulated depreciation is how much? The accumulated depreciation is 40,000. If they have taken for 4 years depreciation, means this depreciation is for how many years? This depreciation for 4 years. Means each year how much is the depreciation? Each year how much is the depreciation? 40,000 is the accumulated depreciation. Is it right? 40,000 is the accumulated depreciation. And this depreciation has been accounted for how many years? 4 years. Means each year how much is the depreciation? 40,000 divided by 4. See the thing. You have how much is the cost? Cost is, I will not write again. Cost is 100,000. Is it right? Fine. I have written like this. That is the confusion. Is it right? Cost is 100,000. Accumulated depreciation is how much? Accumulated depreciation is 40,000. This accumulated depreciation is for how many years? 4 years. They are purchased 4 years ago. See the things. I will put a timeline like this. Is it right? Now they have purchased 4 years ago. Is it right? These are the 4 years ago back side. Is it? They have purchased what? How much? 4 years ago. Now they have a accumulated depreciation. Accumulated depreciation is how much? Accumulated depreciation is 40,000. How many years has been over? 4 years has been over. Is it? 4 years have been over. By this, how we can come to a conclusion? This is depreciation for 4 years. Means every year how much is the depreciation? depreciation each year will be how much? For the last 4 years, for the last 4 years, each year, how much is the depreciation? 40,000 divided by 4 years. Are you okay about this?
Yes.
Now,
Mr. Doubt, Mr.
tell me, dear.
1 by, as Salam asked, 1 by 10. Why we taken 1 by 10? 10, all right, because of the depreciation. But 1, they didn't mention the question first year or second year.
Okay, fine. What they have done, 110, okay, 110, every year how much? Every year how much? 10,000 times 4 years, every year how much? 11,000, okay. How many years are there? For 4 years. Is it right? How many years are there? For 4 years. This they have
Yes.
this they have taken like this, and then they have multiplied by 4 years.
Okay. So we have to show like this. There is no another way, huh?
This is another way.
Like, this is the another way.
This is the simplest way.
All right.
But
Yes.
sir, when we multiply 11,000 by 4, it becomes 44,000.
Why we are dividing 11,000 by 4? No. See the things.
Multiply.
Okay. Why? 11,000 multiply by 4.
Yeah, okay, 44, yes.
Is it 11,000? See, I will make it more simple. 110 divided by how many years? 10 years. Times how many years? 4 years.
Oh. It becomes, yes, 44.
You do it anyway. You do it anyway. The only thing is you should have a clarity on that. Is it okay?
Yes.
Okay, I will show you shortcuts only. My job is I will tell you the shortcuts only. Okay, I will tell you the shortcuts. During the shortcuts, definitely. During the shortcuts, we will come across so many things. Okay, when we are doing multiple choice questions, all shortcuts only. Okay. Now, are you clear about this? 1, 2, 3. Historical cost, net realizable value, and replacement cost. Is it okay with this?
Yes, doctor.
Now, economic value. What they are saying? They are saying that first 2 years. Is it right? First 2 years. This is first year. This is second year. Is it right? This is first year. This is second year. Okay. And for the next 4 years. Is it right? For the next 4 years. When you are saying value in use, we are talking in terms of what? Present value. Is that if maybe you have done NPV, IRR, you have done NPV in your graduation?
You mean net present value?
Yes.
Yeah, we do it.
We have done it. Same thing. Is it right? This is what they are saying. This is, see what, I will write formula here. Cash flow, is it right? Cash flow into discount factor. They have mentioned here, is it right? They have mentioned here in the question. See the thing. They have mentioned here, year 1. Year 1 is this much. Year 2 is this much. And year 3 to 4 equal is how much? This much. How much is year 1? Year 1 is 25,000. Year 2 is how much? 25,000. Year 3 to 6 is how much? 20,000. Now, you will ask me, is it right? You will ask me year 1, year 2 and year 2, 3 to 6. Year 1, year 2 and 3 to 6 means 3, 4, 1, 2, 3, 4, 5, 6. 3 to 6 years means how many years total? It comes to how many years? Okay, fine. 3 to 6, is it right? Now they have mentioned this. We are not doing anything else, is it right? We are just, what they are doing? Cash flow times discount factor. Is it right? Cash flow times multiply by discount. This is the value, this is the formula for present value. I am writing like this, PV. Present value. Okay, present value, what is the formula? Cash flow times discount factor. They have multiplied it. They got it this much, they got it this much, and 3 to 5 years, 3 to 6 years. Okay, they got this much. They have made it the total. This is going to be called as value in use. Is it? This is called as value in use. Is it clear to you?
Yes, doctor.
Is it okay with
Yes.
you?
Yeah. Alright.
Okay, fine. Remember this. Remember this. Understand this. That's very important. Understand. See, first, if you understand, when you are doing practice, you will become perfect. Take my word. Okay? Take my word. Now, in the previous cases, we have done value in use. Now we are doing value in use in detail. Okay? Means these 4 methods will be there. What are the methods? Historical cost, net realizable value, replacement cost, economic value, or value in use. Okay? This very important. That is the basic thing. Alternatives to historical cost accounting, they say that it is current purchasing power, current cost accounting. These are alternatives. Okay? Only here we will discuss. After that we will never discuss this. Okay? Current purchasing, what is the current purchasing power? Okay? The values will increase because of what? The values will increase because of inflation. Is that the values will increase? Definitely. Every other product values are increasing. Marginally it will increase, but it will increase. Okay? It will increase, but marginally it will happen. You know, if the values are increasing, then we'll call it as a current purchasing power accounting. Is that every 15 days, every 14 days, what will happen? They will come up with inflation value. Is that inflation index? Fine. Any prices are increasing or not increasing. According to that, they will adjust the prices. Fine. Now, in converting the basic historical cost into those in CPP statement, we have to, what are the monetary items and what are the non-monetary items. Is that in the examination, in the questions, they will say which are monetary items and which are non-monetary items. Okay. What are the things? I will give the thing. What are the monetary items? Monetary items are cash. Monetary items are receivables, payables, any loan capital only. Understand that? Only. There is no plus, there is no minus. Okay. What are monetary items? Cash, receivables, payables, and loan capital. Fine. What are the non-monetary items? Non-monetary items are includes, what are non-monetary items? Inventory, non-current assets. What are the non-monetary items? Inventory. Inventory is non-monetary. We cannot convert it into cash immediately. Okay. Retaining the historical concepts, fine. That's very important. Okay. I will put it in purple color. As it is, I will put it in purple color. What are the non-monetary assets and what are the monetary assets? Fine. See, the equity interest is neither, it is not a monetary nor it is a non-monetary. Okay. The owner's equity is a residual claim on its net monetary and non-monetary assets. The equity interest is neither monetary nor non-monetary. Fine. They are talking about the same thing. Is it right? What we are talking about, current purchasing, it is simple, it is objective. Read, okay, please. When I am saying read once, okay, because if you skip it, when you are doing MCQ, I will refer this while doing the exam revision kit. While doing the revision kit, I will refer any lecture, any point of time. At that point of time, you should tell, Doctor, it is there in this page, it is this in this chapter. That much preparation we have to do. Understand what? That much preparation we have to do. Inshallah, it will be done. Okay? It is simple, it is objective. What is current purchasing power? It adjusts for changes in the prices. Is it right? Therefore, it is a true system of inflation. It changes, prices are changing, inflation is changing, prices will also change. It measures the impact of the shareholders' purchasing power. What happens if inflation increases? You will buy more or you will buy less? In simple terms, if prices are increasing, you will buy more or you will buy less?
You will buy less.
You buy less. This is nothing but purchasing power. If inflation increases, your purchasing power will decrease. You buy less, okay? If prices are increasing, we buy less. Now, you see the thing. Loan. If rate of interest increases, is that if rate of interest increases, people will borrow more or less? Borrowings will be increase or decreases if the rate of interest is increasing?
Decrease.
People will borrow more or people will borrow less?
Less.
People will borrow less. You will say, my students will say, Doctor, irrespective of rate of interest, we will borrow, doctor, that is different thing. Understand? Okay? That's a but. If the rate of interest is increasing, the borrowing is less. Inflation increases, purchasing power will decrease. Okay? Prices are increasing, purchasing power will decrease. These are the things which have. What are the disadvantages? It fails to capture economic substance. Is that we are talking about general prices, we are not talking about specific prices. Is that there is unfamiliar people who doesn't know about this much. Okay, unfamiliarity with information. We know, we are studying this, but everyone know in the public, very few people know. C people does not show the current values to the business of the assets. Again, as business assets will be based on what? Business assets are based on historical values. All the time. Historical cost. Is it? The general price index is not necessarily appropriate for all assets in the business. They will not see, for learning purpose, you have to remember this, that's all. Okay, you have to remember this. There is a current purchasing power accounting. Very important. Is it? Understanding, remembering and memorizing. This is what it says. I will always say, you have to memorize, you have to understand, you have to remember. Fine. Now, what is the next one? You are talking about current cost accounting. This we are going to use mostly in management accounting. Is it? It is based on the deprival values of value to the business. What is the value to the business? Is it? What is the deprival value is equal to the loss. Sometimes what will happen? The asset value will decrease. Is it? The asset value will decrease. Definitely, what is the current cost? Okay, what is the current cost? And is usually represented. What is the other name for current cost accounting? The another name for current cost accounting is the replacement cost. Where the values will decrease? Inventory. The outdated inventory, old inventory, is that value will decrease. If you have a car model of 2021 and you have the car model of 2024, definitely the 2021 model value will be less. Is that they will decrease and they will sell. Okay, they will decrease and they will sell the value. That is the decrease in the value of the inventory. Inventory and non-current assets are valued at deprivable value. Only inventory and non-current assets. Monetary assets will never be adjusted. Is that monetary assets will never be adjusted. In cash generating units, okay, I am repeating this. In cash generating units, current assets will be taken as a same value. You remember this point? Everyone? In cash generated units, I am writing this. Only current assets. If they have not mentioned anything, current assets will be taken. Cash is taken as cash. Okay, cash is taken as cash. I am not taking, both are similar. I am just relating it. Okay. Any additional charge for the profit and loss accounts, any additional charge to the profit and reflects deprivable value of inventory within cost of, means anything with respect to loss in value. Okay, if it is anything in the loss in value, then we have to identify within cost of sales. Now make it a point. Again, we have done in chapter 2. Is it right? We have done in chapter 2 non-current assets. We will make adjustments for cost of sales. Okay. Now you will not find cost of goods sold. You will say cost of sales. Fine. Again, somewhere in chapter 5 also, 4 or 5, we have done cost of sales, one small calculation. Is it right? Any additional charge to a profit and loss account is deprivable value of non-current assets. With respect to what? It will be treated as a depreciation. If it is related to the inventory, it is cost of sales. Fine. It is related to the inventory, we have to within cost of sales. If it is related to the non-current assets, decrease in value, we have to make it as a depreciation. That now we are going in more detail, but the basic rules will be same. Understand? Revision will be there all the time. Is that they are talking about current assets. It's not a single system of accounting. There are several variants. Okay, fine. The current cost statement of financial statements reflect the current cost of inventory and non-current assets. Fine. At this point, I don't think so. We will cover anything somewhere this over a period of time. Likewise, they have the advantages. Advantages is important is relevance as it relates to the users. People use it. They want to know the current state or the recent performance of the business. Assets are stated at the value. What is the value to the business? Is that current cost accounting? Current cost means what is the current value? Possible greater subjectivity depending on the understanding. Okay, low, it is not that much reliable, lower reliability, is it? Than historical cost. People doesn't know about this, lack of familiarity. It is little bit complex, little bit confusing. They say, okay, we are not going to say. CCA only adjusts for non-monetary assets. It only concerned about what? Inventory and non-current assets. They ignore other assets as such. Okay, you have historical cost, you have current purchasing power accounting, you have current cost accounting. Is it? Now these are the things they are talking about. What are the practical problems? Illustration. Just because this is an example, I will just go through it. Describe the types of business that were most heavily affected by the replacement of historical cost accounting with a system based on current. Business with the following characteristics will have most heavily affected. if you are having large quantity of inventory for a long period of time, is it right? Definitely what will happen? The resulting adjustment will impact heavily. If it is long period of time, is it the inventory value, always the inventory value will increase in future. Is it? Maybe you have done, first in, first out, last in, first out. Is it right? You have done FIFO and LIFO. Is that is from the costing perspective. That is where we are talking in terms of the measurement of the values. Fine. High level of non-current assets acquired long time ago. You have purchased. Okay, I will give a small example. People are there. People say that when iPhone will be launched, new model in the month of September, what will happen? The prices will be very, very high. Assume the price will be around 600 or so. This happens in September 2023. By the time September 2024 will come, the same iPhone will be how much? It will be the same iPhone. It will be around 400 riyals. In September 2025, okay, the same iPhone will becomes to 350. Is it? This is nothing but the current cost. Okay, this is your non-current assets value will affect the profit. Now you see the things. Definitely, it is historical cost. 600 is the history. We cannot change the cost as such. High level of monetary assets. A charge is made to the state. Charge means the loss in value. Okay, charge means the loss in value. Reflect their fall in purchasing value. Be very clear about the things. I know where you should ask me questions. Immediately stop and ask me. Charge means loss in value. Charge will always be taken as minus. You are charging, you are reducing profits. Okay, you are charging, you are reducing the profit. Any loss in value, we have to reduce it. Okay, in simple case, I am not taking that. What we have done in terms of impairment. I'm not saying that this is related to impairment. What we'll do? We will make it minus. High level of borrowings. A credit is made in the statement of profit and loss account to reflect the beneficial effect of borrowing in inflationary times. High level of borrowing. You have borrowed. Okay. You have last year you have borrowed. Okay. Last year you have borrowed to 200,000. Okay, this happens in 2023. 2024. Is that what will happen? Definitely, we are taking the historical cost only. There is no doubt on that. But when you are comparing 2023 with 2024, the concept of time value will come. Present value. I will put like this. I will show you the conditions. Is that 2023, 2024. Is it right? I will write very clearly. The doubts has to be cleared here. You have a cash flow. Is it right? You have a cash flow. Here the cash flow is 100. Is that? Here the cash flow is 100. Here also the cash flow is 100. You have a discount rate. Is it right? You have a discount rate. Discount rate is going to be 10%. Now you want to calculate the present value. Okay? We want to calculate the present value. When you calculate what is the formula? Formula is cash flow divided by 1 plus R to the power of T. Is that 1 plus R to the power of T? Already, how much is there? 100 divided by 1.10 to the power of 1. It comes to how much? Tell me fast. 100 divided by 1 divided by 1.10.
90.90.
90.9. Loss in value, is it right? After 1 year, the value will not be 100. The value will be how much? 90.9. If you are having 100 reals now, after 1 year, what will happen? The value will be 90. The same thing. Is it the same thing? 100 divided by 1.10 to the power of 2. After 2 years. How much is there? Hussein. Salim. Very quick. Calculator, your fingers should move very fast. 100 divided by 1.10 to the power of 2.
$82.
80?
9,000.
82.6.
How much?
82.6.
82.6. This is the loss in value, okay? This is the loss in value. This is where we have to think, okay? This is where we have to think. Means they say that what is the current cost accounting. Is it right? We have to take into consideration with respect to current cost accounting. These are all the things that is part of our entire course. Okay, that is part of our entire course. Fine. Now, are you clear about this? What we have learned? Very simple. Is it right? We have learned about two things here. Is it right? First, we have learned about historical cost, net realizable value, replacement cost, and economic value. Fine. The second part, what we have learned about current cost, current purchasing power, historical cost accounting. Is it? We are talking about current constant purchasing power or current purchasing power based on inflation. You are talking in terms of current cost accounting. Okay, current purchasing power accounting and current cost accounting. I will go to the beginning, okay, to make it more clear for us that what we have covered in this lecture. Is right? See the thing. We have covered historical cost, current cost, value in use. We have not done fair value. Okay, we have not done fair value. What are the advantages and disadvantages? What is the current value accounting? Is that what is the historical cost accounting? Current value accounting. Current purchasing power accounting also we have done. Okay, this much is there in this lecture. Okay, this much is there in this lecture. One time read with understanding. Okay, read with understanding. I am saying this. We are not going to use this in practical terms. There is a possibility that I am writing in big letters. There is a possibility of getting one MCQ on this. Okay, one MCQ on this. And marks are very important. Okay, marks, even 2 marks it makes the difference. Okay, now it is too early to ask. Okay, it is too early to ask, but I am here to help you. Which of the following measurement referred as in a broad conceptual framework? Which one we are taking this out of these options? Can you tell me, please?
The last one, fair value, present value, future value.
Which one?
The last one.
No, it's B.
Salim, what is the option? Check again. Who said D? What is the conceptual framework? Is it right? Conceptual framework. We have done conceptual framework yesterday, last class. See the things. Explain and compute what? Current cost, historical cost, value in use, and what is the next one? What is the next one? Historical cost, current cost, value in use, value is use or fair value. Is it right? Value in use is otherwise called as a present value also. Understand point? Value is use is otherwise called as a present value. Is it right? Now, what is the answer for this? Residual value is there.
B, doctor.
Residual value, no. Okay, residual value, no. Is it right? Future value is there, current cost is there, historical cost is there, fair value is there. Present value is nothing but value in use. Okay, present value is nothing but value in use. Okay, current cost is there, fair value is there, future value is there.
No.
No. Residual value is there.
No.
Answer is
B.
who said B first time?
Yeah,
Don't know.
Good. Okay. Slowly. See, read the thing. It's not. It's you do this. Questions will make very easy. Which of the following statement is true about historical cost in times of rising prices? In time when prices are rising, is it right? When prices are rising, you understand, is that in prices are rising, is that in the prices are rising, historical cost. We will go with the historical cost once. Okay, we have not done that much in detail. Now again once we will say where the historical cost is there. This is the historical cost. Is it right? Historical cost. They have mentioned anything on historical cost? See, accounting, transactions recorded, events no monetary value, income for each is accounted only in the form, period, profit on the voice patch against the cost. Is it right? Fine. You find these are advantages and disadvantages. Is it disadvantages and disadvantages? Okay, I will explain you the each and every point there. Fine. Now, historical prices. in terms of rising prices. Okay, in terms of rising prices. Keep it in mind. You are taking 2021, you are taking 2022, you are taking 2023. Is it right? Prices are rising. Is it right? Prices are profits will be overstated and assets will be understated. Is it right? Profits will be overstated and assets will be understated. Assets value will be overstated. Unrecognized gain will be recorded incorrectly. Depreciation will be overstated. Is that now? You have taken, see the thing, you have taken, assume you take two things, revenue as well as you take non-current assets. Okay, revenue and non-current assets. Fine. Prices are increasing. Is it right? You are selling the same product. Keep it in mind. Product is same. Prices are increasing. Product is same. Prices are increasing. If prices are increasing, what will happen? You are selling it for 200. You will sell it for 275. You are going to sell it for how much? You will sell it for 350. Is it right? Now, non-current asset. Asset is same. Okay, assets are same. Prices are increasing. Is it a same asset? What will happen? Assume asset is 400. I'm taking example. Asset, the same asset you are purchasing 500. The same asset you are purchasing for 600. Is it right? Now, what happens? What happens when the prices are increasing? Prices are increasing. This is 600, this is 500, this is 400. 400 asset is there. We are going to show assume. Keep it in mind. This is for 5 years. All are for 5 years. Okay, all are 5 years. Same asset value. Same asset value. All are for 5 years. Maybe here 1 year is over. 1 year is over. Here 1 year is over. Here 2 years are over. Here 3 years are over. That is a different case. We are overstating assets or we are understating assets? We are overstating assets or we are understating assets? One asset is 400, one asset is 500, one asset is 600. Is there any historical cost? Historical cost. Is it right? Historical cost. What happened? It is uneven. Is it right? It is uneven. One asset is for 400, one asset is for 600. One asset is overstated, one asset is understated. Okay, one asset is overstated, one asset is understated. Now you see the thing. Here you will calculate depreciation how much? Assume here you calculate depreciation how much? 400 divided by 5 years. How much you will calculate? 80. Here you calculate depreciation how much? 100. Here you calculate depreciation is how much? 120. Understand right? Here you are calculating depreciation 80. Here you are calculating depreciation 100. Here you are calculating depreciation how much? 120. Historical cost. Historical cost. Here you are carrying less. Here also comparative less. Here 120. If expenses are less, is it right? If expenses are less, what will happen? The profits will be more. Yes or no? Actually, you have to calculate 120, 120, 120. But that is not the method you are using. Which method we are using? In financial accounting, in financial reporting, we use historical cost. When you are using historical cost, we calculate depreciation also on historical cost. When you calculate depreciation on historical cost, one case you are showing less expenses, depreciation, one case you are showing more expenses. Is that assets? We are not, one side we are showing assets less. Is it? One side we are showing profits more. Okay, one side we are showing assets are less. Is that we are not making equal. Okay, we are not making equal. That is the basic concept of historical cost accounting. In historical cost accounting, what is the most in times of rising prices? In times of rising, condition is there, in times of rising prices. In times of rising prices, we are showing less expenses. If the expenses are less, it means profits are more or profits are overstated. Understand with example, numbers, then it will be easy for us to make a conclusion. Okay? If profits are, when the prices are increasing, is that when the prices are increasing? When prices are increasing, what will happen? One asset we are showing at 600, one asset we are showing at 400. Is it? When prices are increasing, the assets are going to be understated. This is inbuilt. There is no solution for this. This is the limitation also. Is it? We cannot say that there is no alternative for this. And we are following this, and nobody till now, very simple, nobody till now has come with an alternative solution. We will say current purchasing power accounting, we will say current cost accounting, but all through the time, forever, wherever it's possible, we will always use historical cost accounting. Is it? It's not only affecting one, because in other words, in simple words, it is a matching concept. You are matching the income with the expenses. It is, in other words, it is a double entry. Is it right? It is a double entry. Means we have to link it in multiple ways. Okay? If now only one will not get affected. Only one will never get affected. Oh, assets values, only assets will never get affected. One thing. Unrecognized gains will be, there is no unrecognized. We are not showing, we are not saying that it is a matching concept. Is it right? Will be recorded incorrectly. Depreciation will be overstated. Only depreciation is not overstating. Understand point? Depreciation is not overstating. Automatically what will happen? It is also affecting what? It is also affecting the assets. Only expenses are not affecting. Is it right? Only the expenses is not affecting. Means the profits will be overstated and assets will be understated. Okay? Is it clear to you? Fine. It's keep it in mind. I know that when there is a silence, I know you need more explanation. Okay? When there is a silence, I need more explanation. When we are doing another examples, I will explain you and you can give me answer. Fine. Coming to the next one, the third one. What is there? Just tell me. What is the answer for this? Which of the following is the advantage of current cost accounting over historical cost? Advantage of current cost accounting.
Easier to understand.
Pardon?
Easier to understand.
Easier to understand. Check again, current cost accounting. Current
Page
cost accounting. Where is there?
Page 145.
Page 144. What are the advantages? Important advantage, relevance to the users. Where is easier to understand, my dear? Easier to users, able to assess current state of performance of the business. Assets are stated at their value to the business. Relevant, current state of performance, and assets at the fair value. What is that? Easier to understand. This is the advantage of what? Tell me first. Easier to understand. Is it right? Easier to understand. It is the advantages for it is advantages for what?
Historical cost.
It is
Historical cost
advantages
account.
for what?
Historical cost.
Historical cost.
Below.
Is it right? It is where are the advantages of historical cost? Here. Easy to understand is historical cost. Fine. This is related to what? This is related to historical cost. The second one is this is related to what? Less subjective. Less subjective. This is no. This is current cost. See, current cost accounting. This is current cost accounting disadvantage. Is it right? Possible greater subjective and low reliability. Is it right? Possible greater subjectivity and lower reliability. This is current cost accounting disadvantage. Okay, this is current cost accounting. This is more subjective. Is it right? More subjective. It is more subjective. Is it right? This is current cost accounting disadvantage. Is it right? More relevant. More relevant. More relevant where it is there. Objective and free from bias, are reliable and original values comes from invoicing. Historical record do not record gains. Which of the following? Current cost accounting. Current cost accounting. Where current cost accounting? Most important advantage, it is more relevant. See the thing, relevant to users. What is the most advantage of is that it is relevant to users. It is there. Is it right? This is there. This is question number 3. Test your understanding. Is it? Test your understanding. Question number 3. Answer. Is it right? Refer page 150. Is it right? Refer page number 150. Is it right? More relevance. Is it? It is more relevance. Fine. And more reliable is which one? More reliable is historical cost account. Is it right? More reliable is historical cost account. Are you clear about this? I am written here page number also. Is it okay?
Yes.
Is it right? It is page. Are you clear about this?
Yes.
Fine. Read this one, okay? Now, I will stop. I will close the record.